Good morning, everybody. This is Cooper. Remember, I said we might have a special guest appearance. Well, Queen Elizabeth had six dogs. We have four now of these King Charles Cavaliers, and I think she's about 5 weeks old, so she's a cutie pie. And then, of course, there's Max in the background. Assistant here to take Cooper. She doesn't really enjoy these. She hasn't really experienced one of these conference calls. She may just be too young for them. But this is Max. I think I sent some of you folks an email telling you that Max is getting ready for the solar eclipse. And so we're looking forward to that. I have one of these glasses, these solar eclipse glasses. And for the life of me, I put it on and I can see why this protects your eyes, because at least my version, you can't see anything. So maybe it's when you look at the sun that this thing works somewhat. But let's dispense with the Westminster show here. We get rid of the background. So we'll go to the nun, and then we'll leave it at that. Good. And there's Max doing his usual shtick. Max has been on a hot streak. 2 weeks ago, he said the market was going to go up, and the market went up. And this past week, he said the market was going to go sideways, and the market went sideways with some volatility. So he's pretty good. I asked him what he thinks this week, and he's staying on the neutral side here. He's not bullish, he's not bearish, just more volatility. And so we can discuss that scenario as we get into the meat and substance of what we have to talk about. And that's, of course, the economy, domestic and global geopolitics, the Fed, fiscal policy, and no shortage of things to talk about. Well, in the quick takes that I sent yesterday, I kind of reviewed the scenarios that are out there and kind of making analogies using previous decades to the current decade. And the analogies that are relevant are the 1920s, so roaring 2020s. You've heard me talk about that quite a bit. As Seinfeld might say, yada, yada, yada. Then you've also heard me talk about a potential comparison to the 1970s, the great inflation of the 1970s. And then along the way, we picked up the idea that maybe it's going to be more like the 1990s with the irrational exuberance. And then I'm reading Jamie Dimon today, I guess his letter to shareholders, and he concedes the economy's been resilient. Remember back in May of 2022, he said that the economy's doing pretty well, consumers doing pretty well, but it's not going to last very long because the consumers are going to run out of excess savings. And when they do run out of excess savings, then they'll have to retrench, and that'll lead to a recession. And he was very poetic about it, said a hurricane is coming. And now he's saying that the economy remains resilient. I guess that means the consumer is still spending, capital spending is still strong. So that's in his letter. And yet he still isn't convinced that we're going to have a soft landing. We haven't really had a landing at all. I mean, if we had a soft landing at all, it was maybe in the first half of last year, and then things started to fly again in the second half of last year through the data we have right now. And so Dimon was saying that, based on everything he was gathering, it seemed that the markets were giving an 80% chance to a soft landing. And he reiterated that he thought that the odds were actually lower than that. So he kind of maintained his cautious tone, which is fine. He's entitled to have his opinion like everybody else does. And at some point, he may very well be right with his bias towards the pessimistic side of things. But he indicated that he was kind of surprised that given the challenges out there that things have been going this well. But he did say that he thought that the kind of the geopolitical situation around the world was as challenging as what we had, I guess in the 1930s. So now we have 4 decades to consider when we look at at the 2020s, 1920s, the 1930s, the 1990s, and then I forgot the 1970s. Past couple of days, it's really felt more like the 1970s, with the oil price going up over $90 a barrel to $91 a barrel. I think there was fear that Iran would do something this weekend to Israeli assets somewhere in the world, Israeli people as well, of course. And when nothing happened over the weekend, the price of oil's come back down. But the tensions are still there. The conflicts are still there. And I don't see that there's anything suggesting that the geopolitical risks are diminishing. Quite the opposite. I see signs that they're increasing. So the 1970 scenario is still there. In terms of subjective probabilities, we really haven't changed much. We haven't changed at all. 60% likelihood of a roaring 2020s scenario. AI is part of it, but it's a small part of it. Technological innovations that are out there to increase worker productivity, we think, are substantial. And what's different this time is that they apply to just about every business model. Back in the 1990s, the technologies that became available, particularly things like Word and Excel, had very limited applications to lots of businesses. So they really weren't big productivity enhancers. But now with automation, robotics, artificial intelligence, and so on, I think the potential for increasing productivity is much greater. And in fact, this is not necessarily a forecast anymore. As I pointed out, we had really good productivity numbers last year. In the last 3 quarters, 3 out of 4 quarters, the last 3 quarters of last year, productivity was above trend, suggesting that things really are improving on the productivity side. Then again, we just had some really strong employment numbers. Maybe depending on what GDP numbers do, we'll get strong productivity numbers in the first quarter. But right now, it looks like it's not going to be anything all that exciting. Won't be bad, but it won't be confirmation of what we've seen in the past 3 quarters. So, productivity is a work in process. It's a long-term trend, and we'll be continuing to follow it. So the outlook for the economy remains quite strong. We had those really strong employment numbers suggesting that things are still pretty good. The topic of the morning briefing today is, in fact, is titled "Hooray!" Hip hip hooray, or I should have written maybe, but hooray! The recession's over. And the idea is that Jamie Dimon and others were very concerned about a recession over the past 2 years. It's the no-show recession. It didn't happen. Yet it must have had some impact on hiring activities. If there's such a widespread fear of a recession and people like Jamie Dimon are saying it's coming, do you really want to hire? Well, the answer is a lot of companies continue to hire because their business was good and they needed to get more employees. But they found that there were shortages there, and hence there is a kind of a chronic labor shortage out there, at least of skilled workers, and that's where the productivity comes in. But all in all, the economy continues to perform well. The recession fears have abated, and as a result of that, we may get some better than expected employment numbers as companies that might have held back on hiring decide that no recession, business is still good. Let's move ahead and do some hiring. Meanwhile, we are seeing job openings coming down somewhat. Some of that is related to the fact that quits are coming down. People aren't jumping ship the way they had been. Maybe they're starting to realize that you don't gain that much in terms of higher wages, or what you gain in higher wages, you lose in terms of the people and the job and so on. But we are seeing less jumping, less quitting to go to higher wages, and that also helps to bring wage inflation down. But if you have fewer quits, you have fewer job openings, and therefore you have fewer hirings. But at the end of the day, the labor market looks quite strong, with initial unemployment claims still right around 215,000 or so. 220,000 was the last weekly number. Let's look at some of the data points here. I did mention that I'm looking for 60% on the roaring 20s. I should have mentioned 20% for the 1970s scenario and 20% for the 1990s scenario. So it's an interesting time. A few weeks ago, I was kind of focusing on the comparisons to the 1990s because that's the way things were sort of playing out. And now with the past couple of weeks, with the price of oil going up, with the geopolitical tensions rising in the Middle East, the 1970s is becoming more relevant. I'm not changing my probabilities at this time. I think some of these things are, we just have to kind of watch them and assess them as things go. But let's share the screen here. And so we're doing the April 8th, that's today, the morning briefing. We're all getting excited about the eclipse. So without further ado, let's get into this. So here we have the non-farm payroll employment, the total month change on a month-over-month basis, and this is the total. This is the total private, so it excludes the government. And maybe I'm making too much of it, but this is basically, this is in fact March. So we got January, February, March, and then we've got the previous months last year, and you can see that there was a little bit of a swoon here in net increase in payrolls, picked up for 1 month, then it kind of remained in this swoon situation. But recently we've seen the payroll employment numbers in the private sector pick up, hence my conclusion that maybe the recession's over, or at least the recession thinking and the recession fears are over, which might lead us to a continuation of better than expected payrolls. Here's payrolls with and without the government, all-time record high in both cases. What's important about this number is it's one of the 4 components of the index of coincident economic indicators. And I think that's been much more useful in concluding that we're not in a recession and that we're not going into one, as the coincident indicators have continued to increase to record highs on a month-over-month basis. And over the past 2 years, meanwhile, the leading economic indicators have been going south, predicting a recession. And so far, the coincident indicators has been getting it right, at least on a kind of a very short-term basis, where the leading indicators, which are supposed to give you a lead time here, it's maybe time to, as I said before, have a product recall. It's just not working the way it should be working. And I think that's because and I've said this many times, written about it, that the index of leading economic indicators has some flaws. It seems to be very biased towards goods, and there definitely has been a goods recession. We can look at goods real GDP. It hasn't turned negative, but it's been slower growth in services. We can look at the ISM manufacturing index, and until this last month, until March, it had been below 50 for, I think, a year and a half, maybe 2 years. Retail sales adjusted for inflation have been flat. Consumer spending on goods has been flat. By the way, it's been flat at a record high. So we had this binge in consumers shopping on goods coming out of the pandemic. Then that binge lasted about a year and a half, 2 years, and then it just went sideways. It's not as though people just suddenly stopped buying consumer goods and they went south. They went sideways. And so again, just shows the resilience of the economy. So we have 1 out of the 4 components of the coincident economic indicators, and guess what? It's at an all-time record high. So it's already telling us that maybe the CEI in March rose to another record high. But we have more indicators here. If we take the not the private sector payrolls, and multiply it by the average weekly hours, and multiply that by the average hourly earnings. So you get total aggregate hours worked, because that's the work week times the number of people working. And then you multiply that by wages, you get total private sector wages and salaries. You get a proxy for it, and that's what this is. The blue line is a proxy for it, and it rose quite sharply in March. It rose 0.8%. And it suggests that the wages and salaries component in personal income, which you can see, this is really, I'm pretty sure that the Commerce Department actually uses this series, which we call the earned income proxy, and we keep talking about it ours as though we invented it. Well, we did sort of, but I have found out subsequently that this is the way the government calculates total wages and salaries in the private sector in personal income. So that's likely to also have been up sharply in March. Why is this important? Well, it's another component of the coincident economic indicators. Personal income adjusted for inflation less government transfers is the second component of the CEI, the coincident economic indicators. And so that's likely to be up at a record high as well. This is the nominal number, but it was up 0.8%. That is bound to have beat inflation in March, which the CPI tomorrow is widely expected to be up like 0.3%, maybe 0.4% on a headline basis, 0.3 on a core basis. You can look at this chart on your own. There's a lot of series there, but the basic message of that is that if you look at the earned income proxy variable in here, which is the blue line, it really does set the trend line for things like core retail sales, core consumption, consumption of personal consumption expenditure of goods, and so on. So it suggests that retail sales could be pretty strong when the March data comes out on April 15th. Well, why is that important? Because that's the third component of the coincident economic indicators. The third one is actually called real manufacturing trade sales. So retail sales is part of that. And so that should be a contributor to making that number go to a record high. So I think it's pretty clear we're not in a recession. The momentum is still for the economy to be growing. The one clunker here is the fourth component of the CEI, and that's the U.S. industrial production. That's in there, and that's the blue line, and it's actually been kind of, depending how do you want to look at it, they've been down a little bit or moving sideways. I see sort of more of a sideways action, but this is the manufacturing component of industrial production. And again, when the payroll numbers come out, when the employment number report comes out, we do get an indicator for production called manufacturing aggregate weekly hours, and they were up the past 2 months. So that's encouraging, but this is not going to take it up to a new record high. Well, we've discussed this before. I just wanted to go over it again, that one of the reasons the economy is doing so well is because we've got more seniors that are retiring, and they have retirement assets that are substantial, and they're spending that money. And this is by way of segueing to why is employment so strong, and where is it strong? And guess what? It's strong in the areas where the retiring baby boomers are spending their money. So here's the retiring population. This is seniors in the civilian population, and here's the ones that are not in the labor force. So 48 million Americans are seniors, and they're not in the labor force. So I have to believe a lot of them are the baby boomers, retired baby boomers, and they have a lot of assets. How much do they have? Again, we've discussed this before. The total household sector's got something around, well, it's got $156 trillion at the end of last year, and the baby boomers had 76 trillion of that. So that's substantial. And this goes back to what Spock said in Star Trek. Star Trek is something a lot of us baby boomers watched, but Spock said, live long and prosper. And that's the key here to the wealth of the baby boomers. They've lived long. They've been investing wisely in houses and insurance policies, stock market, bonds, and they have accumulated a tremendous amount of wealth. Of course, it's not necessarily all equally distributed, but I think this chart indicates that one of the reasons we have income inequality, wealth inequality in our country has to do with the aging. Older people simply have more wealth, and there's more baby boomers out there, and so they've accumulated a lot. And the younger folks, I think, can look forward to some inheritances if we baby boomers don't blow it all on trips to Europe and fancy meals in restaurants and all sorts of healthcare needs that we pay for just to keep ourselves able to do all this all these fine activities like climbing Mount Machu Picchu. So here we got healthcare services, all-time record high. Spending on this is this is spending on healthcare services, all-time record high. This is payroll employment in healthcare and social assistance, all-time record high. A lot of demand for the consumption of these services. A lot of demand for workers to provide these services. This is leisure and hospitality, kind of leveling off, but back to its record high, matching at least what we had before the pandemic. And here you can see that payroll, that's employment, right? So we had, see, what am I doing here? Yeah, leisure and hospitality employment, all-time record high. We know that spending in this area is all-time record high. We've got financial activities. People have more wealth. They need financial services. So you can see that payroll, all-time record high there. Interestingly, I decided to put employment in nursing and residential care facilities versus childcare. So this is childcare, almost at a record high. It's come back from the pandemic scarcity of workers. As people are going back to work, they're finding putting their kids in childcare. Well, what happened to grandma and grandpa? Why can't grandma and grandpa take care of the kids? And the answer, why is there so much demand for these childcare facilities? And the answer is grandma and grandpa are either traveling around the world or else they're in nursing or assisted living. So that's kind of a related concept there. What else do I want to talk about quickly? Yeah, wage inflation's come down. It's come down to 4.1% for all workers. So it's still moderating. I think Fed Chair Jerome Powell has said that he'd like to see it more with a 3 handle, something around 3.5%, figuring that if he gets inflation down to 2%, then the increase in real wages can be accounted for by productivity. I think he's being too conservative on productivity, but he has to be. It's not his nature to. It's not the nature of his job to do what I do for a living, which is make forecasts, and sometimes ones that may appear delusional, but work out hopefully. Sometimes they are just simply delusional. But meanwhile, the real wage declined just a little bit during February, but we're still back after seeing stagnation in real wages. We're back in an upward course on real wages. And that's consistent with my view that productivity is making a comeback and real wages should be, it's a good monthly indicator of what productivity may very well be doing. Finally, you can look at the section I wrote on the importance of foreign-born in the labor force. We really, honestly, we don't know what's going on in the labor force. From what I understand, there's about 7 million now, call them illegal migrants, undocumented migrants, newcomers, whatever you want to call them. We got 7 million new friends here that have crossed the border. I like to call them Biden migrants because he's the one who's clearly been the most welcoming in this process. But so we don't really know how many of them are in the labor force because even if they get jobs, they're likely to be off the books. They're not likely to volunteer. If they somehow get surveyed on their job status, they're not going to volunteer that they're working. And their employers, if they're working off the books, they're not going to necessarily show them. They're not going to show them in payrolls. So we simply don't know. And so the kind of flying blind here in terms of their impact on the economy, on productivity, on inflation, and so on. But we'll do the best we can with what we have. But you can see that foreign-born, which presumably are the people that are born overseas but are legitimately here and are legitimately working. That's some of the data here, and you can see the foreign-borns have had a bigger and bigger impact on our economy. For example, this is the labor force. What the labor force looks like in total. This is what the labor force looks like without the foreign-born. So it has had an impact. Well, I covered everything I wanted to cover. Let me know if I missed covering some issues for you, and if I didn't come to a conclusion in a point or two. I know that I almost forgot on giving you the subjective probabilities on the decade scenarios. So far I got one question. I got one observation from Ian. He said it's a cute doggy. I agree. So now we got Jeffrey here. Let's see what what are your thoughts on gold reaching new highs? What is this anticipating? Glad you asked me. I wrote the quick takes yesterday, was speculating in the possibility that gold might go to 3,000 or 3,500 possibly between now and the end of 2025. I speculated that would probably be associated with the price of oil going up to 100 or maybe even higher. I think what we're seeing in gold, what we're seeing in oil, is a lot of concerns about the geopolitical risks in the Middle East. But it's not just there. Let's not ignore the fact that there's an ugly war going on that was started by Russia against Ukraine. And I just read the headline that the Russians attacked their huge nuclear power plant with drones, and that was the headline, and that's all I read about it. But that's a pretty frightening kind of headline. And meanwhile, the Ukrainians, I think, have been probably held back by the U.S. and said, "We'll give you whatever we give you. Don't go and start hitting Russian facilities directly." I mean, if it's a war, it's a war, and the Ukrainians have basically ignored that advice, or at least they've used their own homegrown drones to take out some targets in Russia, including refineries. So, if we have a combination of less Russian oil, I know it's sanctioned, but nevertheless, the Chinese and the Indians are buying lots of it. But if there's less of it because Russian refineries are being hampered by drone attacks, and if we get an increasing confrontation between Israel and Iran that threatens to have an impact on the price of oil, then we could very well see $100 oil, and I think that's what the price of gold is reflecting. I'm sure there's lots of other possibilities here, like nobody except politicians likes the amount of debt that's being accumulated by the federal government. I think on Wednesday we're going to get a report from the government on its latest budget, and undoubtedly we're going to see a shocking increase in the net interest paid by the government to over $100 billion in the past 12 months. It's going to be bigger than defense. It'll be shocking, but it won't be surprising. Everybody's known about this. I mean, the 1970 scenario, again, I'm giving that 20% subjective right now, though it's on my mind because of recent events. That would add up with suddenly we get more inflation, we get a higher bond yield. Can't dismiss a 5% bond yield, revisiting that in that kind of scenario. And then we get miserable auctions again because the amount of supply is still out there. The reason the auctions have gone well is because since November 1st, Janet Yellen's reduced the amount of notes and bonds that are being used to raise money and putting more of it in bills. But we've also had inflation moderating, which has helped to bring bond yields down. And lots of talk about the Fed cutting interest rates. The Fed's only officially in their summary of economic projections been talking about 3 rate cuts this year. And they're still sticking to that in the summary of economic projections, though the chatter around that is a little bit more hawkish from Powell, a little bit more dovish from others. But the bottom line of it is the Fed's only been talking about 3 rate cuts this year, and the markets earlier this year got ahead of it and said 6 to 7 cuts. I never could understand where that was coming from. But now, given where the 2-year is, given where the 12-month futures is, the market's in line with the summary of economic projections with the 3 rate cuts. But I think that may not be realistic either. I think there may be no rate cuts this year. And if we have any, and if it's 1 or 2, it's likely to be after the election. So the November and December meeting. The November meeting is right after the election. Okay, we got some more questions here. William, some were commenting that last Friday employment number was part-time. Any comment? Yeah, I mean, you can slice and dice these numbers all sorts of ways. Oh, I guess Max had enough, or he's getting ready for the eclipse. But you can slice and dice it all sorts of ways. I mean, part-time could be a voluntary situation. It doesn't necessarily mean that employers, maybe that's all employers can find, is they clearly have been searching for workers. We know that there are lots of job openings, and maybe they're finding that the only workers they can attract are those who want to work part-time. So I don't really view that as giving you any real insight into whether the labor market is strong or weak. Steve, how much has inflation been affected by the government program's infrastructure over the last few years? Undoubtedly, stimulative fiscal policy has been a source of inflation, but the fact that inflation's come down so rapidly, particularly for goods, really does suggest that supply disruptions on a global basis has been a key factor. You know, Janet Yellen's over in China. I don't know if she's back yet, but she was over in China trying to convince them not to dump goods in global markets. There's a recognition that the Chinese just can't seem to get domestic demand going, and that they're resorting to the same old approach of stimulating their manufacturing for exports. And the concern is that they're going to do that willy-nilly, subsidize it, produce a lot of solar panels and electric vehicles and all kinds of other products that they'll dump in the global markets, and that'll cause deflation and put their competitors out of business because they're being subsidized by the government over there, which is desperate to offset the deflationary, recessionary consequences of the property bubble that has burst over there. So I think we still have a lot of disinflation, deflation on the good side, and services. I don't know that has much to do with infrastructure spending. But it's still a big part of it in the CPI and PCED is rent inflation. And it was interesting to see that the multifamily residential construction, the completions rose sharply last month. So maybe we're starting to get a glut of these things. Gus, we'll take that as the last one. Ed, it looks like Europe and China are either stimulating their economies or contemplating stimulus, lower rates. Do you think growth accelerates and inflation? I think there is some evidence that the global economy is doing better. We're starting to see that in some of the PMIs. Global manufacturing rose above 50. But again, how much of this is countries trying to stimulate their economies, manufacturing, only to create a deflationary situation? But yeah, I said the price of copper has been going up. On the other hand, the price of iron ore is going down, suggesting that China is still going to remain a weak spot in the commodities that are necessary for building structures. So with that, thank you all for tuning in. Make sure you don't do any damage to your eyes when this eclipse comes around, at least in this part of the world. And thank you all. Let's do this again next week. All the best.